Okay, we might make a start, everybody. Thanks so much for your time this morning, everyone, for making the trip up here today to what is the 14th instalment of the Noosa Mining Conference. Incredible numbers again this year. Just talking to Phil outside, I believe we've got around 65 companies representing themselves, and we've got around 1,000 delegates registered. That's within spitting distance of a record of around 1,040 delegates. So it's pretty much record numbers again this year. And that's a real testament to the quality of the offering that's provided by Phil and Des and the team at Noosa Mining, and the genuine level of interest in this very important sector in resources, and particularly junior resources. I'm really pleased to say that Morgans continues its strong affiliation with the conference. This is our also 14th year of providing support, involvement and engagement at every level to be involved with Noosa. And again, I'm really pleased to be able to say that that continues. Now, before we launch into our expert panel, I just want to give a big shout out to Phil and Des at the conference here for their ongoing support and their generous support of the Morgans Big Dry Friday fundraising effort this year. So for those of you that don't know what Big Dry Friday is, it's a day designed to connect city and country. And it's a day to raise funds to provide support across education, mental well-being, and those suffering financial hardship through natural disasters. A lot of those issues do have a big presence in country regions. So Big Dry Friday has raised more than $6.2 million over the last 6 years, thanks to the support of many generous corporate partners, family foundations, and everyday Australians. To that end, I'd encourage you all to come and see us at the Morgans booth. Please come and get involved in the Rossi boot raffle. As you may know, Rossi is owned by Mrs. Gina Reinhardt's Hancock Agriculture business, and we are thrilled this year to have them on board as a strategic partner of Big Dry Friday. So please come and get involved. So on to another huge conference, and we'll get straight into it here. We thought this year it'd be great to pick the brains of some industry experts, particularly some guys with really deep experience in juniors. So it's my pleasure this morning to introduce our two experts in John Forwood and Tony Manini. Just a couple of their bios. So John has qualifications in both geology and law. He's got extensive resource sector experience, including hands-on roles in geology and exploration geology, project financing in the junior resources space via a long career at RMB Resources, and a long career now in funds management as the current CIO of the Lowell Resources Fund. That's since 2016. John's certainly got his eye in at Lowell. I believe the fund, John's done 27% or so compound for the last 5 years or so. So that's an exceptional return, uncorrelated to the market. You can take exposure to John's expertise through the listed ticker LRT, that's the Lowell Resources Trust. Tony's also a geologist, held several executive level positions at Rio Tinto in a long career across several functions, commodities, jurisdictions, but Tony's perhaps better known for his post-Rio life as a co-founder of the project incubation group Tigers Realm Group and of the private equity group EMR Capital. These groups have had a direct hand in several mining success stories, including Oxiana, which became Oz Minerals, NextGen Uranium in Canada, and Tigers Realm Coal, along with AsiaMet Resources. So really pleased to have the wealth of expertise in both John and Tony in the room today. That's enough from me. We all want to hear what the experts think. We're going to dive straight into it. So I do have a few questions for you, gentlemen. The cycle in general, John, you in particular, you've spoken about a trio of headwinds that have been facing junior resources companies and explorers. Maybe if you can elaborate on that and perhaps explain to us whether you think that's a risk or an opportunity.
Look, I think we've seen at the moment the junior resources sector represents really undervalued sector at the moment. We've seen the weight of money really rush to one side of the boat, and that's really represented by Nvidia and you know that sector. The bigger getting bigger and the smaller getting smaller. So the junior resources sector has been hit by what I call this triple whammy. One is commodities are undervalued vis-a-vis the equity market, and we've seen the equity markets hit all-time highs again last night. We've seen resources companies be undervalued against their own commodity, and for example, you can see the gold equities index disengaging from the gold price over the last 12 months, 2 years. And then with respect to the junior sector, you see the juniors definitely being underperforming the larger tiers in the mining sector. So there's for the juniors, there's really a triple whammy. And I was just saying to Tony when I was recently in North America, a couple of the North American brokers said to me, the TSX Venture Exchange resources sector is never coming back, and that was music to my ears, because that's capitulation. And when capitulation happens, you're at or close to the bottom. So I think the bottom for junior resources probably came in sort of in October last year or February this year. We had a little run in April and we pulled back again, but we're definitely up off the bottom. But I think that the sector still represents some fantastic value. In fact, the value is almost too good. For a fund manager like me, it's like being a kid in a lolly shop.
Terrific. And Tony, pretty much the same question. You've seen a lot of these cycles. Where do you think we are for juniors in the scheme of things?
Yeah, just John's comments, just elaborate on those a little bit. I mean, the commodities prices as they sit today, I think everybody here will realise the pricing's very good. I mean, I hear all this, copper going to over $5 and gold going here. I mean, gold's at an all-time high. Copper, if I go back 4 or 5 years ago, we dreamt of $3. It's $4.60 something today. So we have, and you look across the board, some of the other sectors, obviously, where you've got small markets and you've had high compound growth, have been hit hard, but they'll rebound again. So there is a big disconnect between commodities prices and the prices of the equities. I think the bigger guys, as John said, have moved up and followed those up. Some of the sort of small to medium guys, which have outperformed in terms of delivery, have actually done extremely well, but the broader sector remains very beat up and undervalued. So, there's a wide range that sits in there. You've still got to be very selective about what you're looking for, but the universe is large. And as John says, as an investor, it's like, there's some real deep value to be found there.
Terrific. And we might bounce around to some hot topics. We'll come back to gold in a minute, but John, very curious on your thoughts around exposure to the transition metals. So the lithium, rare earth complex, some of the specialty metals. I'm curious about your views on the outlook for those segments. They've had a horrible 12 months just recently. How do you think about those opportunities and where do you prefer your exposures?
Yeah, I think just talking about lithium first, it's been a very kind commodity to our fund, but it has been through 2 booms and 2 busts, and currently we're in the midst of a bust. At the start of this year, I was saying I think 2024 is a little bit going to be a bit of a battle between the ICE and the EV, represented by, say, the auto catalyst demand from PGMs and the lithium demand from EVs. Halfway through the year, it looks like the winner is actually the hybrid, in between. So perhaps that means that both PGMs and lithium are winners, but lithium is still very much in a bust. I think that lithium is still a very small market. We're seeing some of the oil majors come into the lithium space, through brines that they might be producing anyway or have access to anyway through their wells. But that, to me, that's really just that's just greenwashing, because the lithium market is so small vis-a-vis the, say, the oil market. But that means that it's volatile. And so we've seen it volatile on the upside. We're now seeing it volatile on the downside. I think it'll be volatile again, you know, and it'll bounce back. The EV thematic and the transition to EVs is not going away. Yeah, I think we'll see a bounce back there. Rare earths is perhaps more difficult. It's certainly a market dominated by China. And you've really got to take a view on what the Chinese are going to do in the short term. Having said that, some of the Western world projects that we're seeing, particularly in Brazil, but also in Africa, are really stellar in terms of their geology and in terms of their metallurgy. So I think there could be eventually a move to more Western production of rare earths. So I think some of these opportunities where the metallurgy is good and the grade is good, you know, will eventually win out the Western producers.
If I can just add a few comments there, Tom. So just as John said, these are essentially at the moment niche minerals and small markets, so high volatility. There's been a lot of excitement around the critical minerals thematic in general. I have three key questions when I look at one of these situations. Number one, critical to who? Number two, critical in what volume? And number three, how much money solves the problem? So if you apply that, you know, those three questions, you'll find that it's small volumes and not a lot of money resolves the problems. And most of these things that are critical to governments, and governments don't necessarily give a damn whether we make any money or not, as long as their problem is solved in terms of the critical minerals supply. So that said, there's a couple of other key things that I always consider. Another takeaway is never make your primary product what is somebody else's byproduct. It's never a good space to be, because ultimately a byproduct credit is always going to be a much lower cost of production. And then in the third piece is really, you say, okay, what's the issue here in terms of money? So is there a physical constraint to the commodity? So if we look at lithium, and John's noted lithium, there's no shortage of lithium on the planet, and we've seen the number of different forms, and, you know, I guess when the market's high, responded, and then we've ultimately seen the market sort of collapse, because it's not physically constrained, it's constrained by the momentum of money being deployed to bring on new supply. So they are the sort of key considerations which I think you need to think about when you're investing in those spaces.
We might stay with you, Tony. You've got quite a depth of experience in uranium. A lot of debate in a lot of developed economies now around nuclear. A lot of pundits debating whether there's another 100% in the uranium price. What's your view?
I go back to my opening comments. Uranium's fourfolded in the last 4 years, so that's not a bad move up. And I think if you look around, you'll see that supply, you know, the incentive price is there for new supply. So the new supply is coming. I mean, there's been, you know, a number of new projects come online, but I think the key thing with uranium is the permitting timelines. I mean, permitting timelines are a big issue across the entire sector, but in uranium, there's a lot of government regulatory overlay, a lot of environmental overlay, and the timelines are very long. So as an example, I was involved in setting up NextGen Energy back in 2009 with Lee Courier and Andy Brown, made a world-class discovery on the second drill hole. And we are now in 2024. The guys have done a fantastic job. They've done everything right with that asset. You couldn't do better, but they've still got a fair way to go with the permitting. So the lead time in bringing on new uranium production is very long. So I think those that are in production or near production and can come on fairly soon will do extremely well. And I think the supply response will be slow. A lot of focus has been on demand. So but you sort of got to put the demand in perspective. We hear 53 new reactors in China and 28 in the pipeline. There are actually 300 reactors worldwide now. So you've got to get those sort of numbers in perspective. But, even in the US, I think there's 50 something across 28 states. Canada's got 19. Europe's got 167 or something like that. So I think if you sort of think about, okay, the fourth industrial revolution, which is, the AI-driven technology piece, plus the green energy transition, it's all about electrification, right? And it's all about stable baseload power. So nuclear is going to have and we're seeing the nuclear discussion and debate really rising up now. So I think there's no doubt that nuclear is going to be a larger component of the global energy mix and security of energy as well. I think I don't expect the uranium price to be doubling. I think the incentive price is here already. It's a very strong price. And if you've got a good project, now's your time in the sun in the uranium space. So I don't think we need to see it double again from here. I think the times are good for uranium already.
Thank you, John. I notice you've got a couple of gas stocks in the top 10 holdings in the fund. Curious about your thinking there, whether it's deliberate exposure to the commodity, you're thinking around fossil fuels perhaps, or whether it's a stock-specific call on those names?
Yeah, look, there are a few similarities between gas and uranium in my view that I think, when uranium prices were low, the utilities didn't provide higher term contract prices to bring these development projects online. And they thought, oh, these cheap prices will go on forever. And similarly with gas, particularly here in Australia, I think, when gas prices were $2 or $3 a gigajoule, the off-takers didn't say, okay, well, let's put in a 5 or 10 year contract, at slightly higher price to incentivize new production. And now we're seeing, prices, $12 a gigajoule is sort of the new floor on the East Coast, and the West Coast, we've seen it go to, $9 or $10 a gigajoule. So that's the price sort of scenario. In terms of the political will, we've seen what I think has been a massive backflip and about turn. I'm based in Melbourne. We've seen the Victorian government finally issue the first gas extraction permit in 10 years of being in power. We've seen the federal government also say that we do actually need gas. So I think that we've got a number of investments. One here in Queensland in Comet Ridge, which is a near-term gas producer, and then we've got a couple of explorers with some very high impact wells coming up over the next 3 to 12 months, which hopefully will bring new gas discoveries to bear.
Terrific. We might just park a gold discussion briefly. Key picks. I'm going to put you on the spot here. Can be a thematic, can be a commodity, could be a jurisdiction, an election outcome, or a stock. Tony, key picks for the next 12 months. Put you on the spot.
Yeah, look, I think John alluded to it. I think there's the Canadian space is particularly beat up in the junior sector. So myself, I've had a bit of emphasis at looking at what opportunities there. The way I sort of describe it to people is they're very different markets, Canada and Oz. If you look across Australia, similar geology, I always ask, how many undeveloped million-ounce gold deposits are there in Australia? And the answer is not many. And if you go to Canada, there are other reasons, but because of some of the environmental sort of issues, but there's hundreds of undeveloped million-ounce gold deposits. So, and there's fundamental differences in the market. Australians look to build mines. I think the Canadians look to play the market a lot more. So I see, value opportunity there. And then look, in terms of particular things, I'm not going to say anything that I'm actually on the board or involved in, but I like Pampa Metals, which is listed on the CSE. It's a 20 million market cap Canadian company. It's got 4 drill holes, which look like true ore grade intersections, copper gold, very similar to things you'd see at, existing operating mines. It's in Argentina. Argentina's got strong tailwinds. It's in a good location. It's well run. So that's one that I've sort of, I think is a good proposition. The downside is limited. I think the upside is pretty large. So I like those situations.
Terrific. Thank you. And same question for you, John.
Oh, look, I'm not going to play favourites, in our portfolio, but and we do really think that gold has got further to run. So we're definitely overweight gold. But I think perhaps some things that might have been overlooked are the more minor metals that have had really good runs this year. Talking about things like tin, well up over $30,000 a tonne. Bauxite has been very strong, although there is some talk about the Indonesians revisiting their bauxite export ban. And manganese, with the Groote Eylandt closure, we're seeing that price up, I think, 85% on the year. So I think they're, some of the minor metals that can get overlooked, but definitely worth having a look at.
Thank you. And an unprepared one, we've got 3 minutes, probably the hardest question I could ask you, and a real driver of short-term direction in commodity markets is China. There's a lot of debate at the moment around the plenum that's underway, the 5-year plan upcoming, overcapacity that might be removed, and we've seen big moves in commodity markets early this year, and some of those moves have come off. Insights into China just recently, Tony, how are you thinking about it, and what kind of tailwind might that provide?
Yeah, look, I mean, we sort of sit in one part of the world and look at China, but, we're active sort of globally. So we see the Chinese still extremely hungry for raw materials. So they're very active in South America, Latin America, and China, not so much sort of in Australia, Canada these days. I think, there's a couple of little key things that I've sort of noticed is that I think Chinese investment, if you notice, there's been quite a few deals done just in the last few weeks where they're deploying capital again. So that's a turning point. And then I seen a snippet in the Financial Times, and others may have seen it just in the past week, which said China's got the largest installed capacity of solar and wind globally. They, in many of the provinces, they've been unable to connect into the grid because the grid can't support that generation. So they've just given the go-ahead for an $860 billion revamp over the next 5 years of their electricity transmission grid. So I think, we'll see, pretty strong sort of tailwinds coming from China for commodities on top of everything else we've got going on.
Thanks, Tony. And same question, John.
Yeah, look, 100% agree. Just anecdotally seeing, Chinese companies looking for projects, in copper, for example. Not so much in Australia. I think the FIRB has sort of put paid to a lot of Chinese investment in Oz, but certainly in Africa and South America, you're seeing a lot of that. One thing I would sort of interesting, just that comment about the grid in China. There was an article this morning saying that the biggest buyer of copper in the world, which is the China grid company, has now switched to buying more aluminium. And that is presumably a response to the higher copper price, because aluminium can be substituted for copper in grid, in transmissions. So they always say the cure to low prices is low prices, the cure for high prices is high prices. So you are seeing a bit of substitution start to come in copper.
Terrific. Gentlemen, can't thank you enough for being so open and honest and frank with your insights there, and look forward to sharing a few more over a beer at the bar later in the day. So please join me in thanking John and Tony.